Today we're going to talk about companies' investments. In today's class, I want to focus on how we interpret what should a good accountant do. During our last talk, I mentioned that I view this advanced class as a good opportunity for us to enhance our accounting knowledge, to go through, give a recap, so we know what we are missing, right? We know when we talk about accounting, many people say that many books actually tells us accounting is business language, which when I was younger, when I was starting my profession career, I thought it was a joke. Everybody knows that, but it means nothing. But now I look back, it means a lot, right? Let me ask you guys, I guess we all know English, right? So what is language for? Language is for communicating what you know, what you think, right? So you have to know, no matter what language you speak, what language you are very good at, very fluent with, it's important to know what you want to tell us, what you want to communicate first. Then you use the language to communicate. And the language is supposed, when people say that your language is very accurate, what we are saying is what you're saying captures what you want to say. Right? So accounting is no different. Many people just interpret accounting as journal entries. Sometimes we debit this, sometimes we credit that. And the total debit has to equal total credit, which is not wrong, but this is kind of very different from a language perspective because we ignore the parts, what is a language, what is accounting trying to capture, right? This is very important because only if we really know what we are trying to capture, and that we can really communicate. Only building on that, we can communicate to other people, and we can do very, very good journal entry. Only if we understand what the companies, what the businesses are doing financially, and then we might, only if that happens, then we can use accounting to really make good journal entries. Okay. So if we look at general accounting stuff, I would say that, on the left-hand side, accounting is about when we look at the balance sheet, right? Balance sheet is, I'm going to ignore that. Anyway, so this is something we're going to be focusing on. So during the process, when we are talking about consolidation, partnership accounting, I'm going to be reminding you guys again and again the principles of accounting. That is, we have to understand transaction first. We have to understand what happened first. So when we are looking at the journal entries, I hope we are not just mechanically reading it as debit something, credit something else, right? I hope what we are doing is we really see what happens. Then we can use our English to capture in a probably not so much accounting manner to capture, to tell us what happened. Okay. For example, if we say the debit cash 1 million, credit sales 1 million, we can just read it, right? It's nothing. Most people know, but people with no accounting background don't know. But if you can tell us this journal entry means cash sales in the amount of 1 million, then we understand. It's more accurate, right? Those with accounting background knows it's debit cash 1 million, credit sales 1 million, and those with non-accounting background knows exactly what you're talking about as well. Because we are talking about nature, the underlying events, rather than just reading it aloud, reading the journal entries aloud. Do you see that? I hope we are doing that. And in this class, I'm going to also try my best to rationalize all the journal entries. Hopefully, they will make sense, right? So let's see if that will help you or not. So when we talk about consolidation, I mentioned this already. Consolidation takes place usually among 2 or more companies. Although it's a group of companies. Of those companies, usually there's one holding company, which we call parent company, and the others we call subsidiaries, right? In our case, holding company controls subsidiaries. This is what a consolidation needs, right? But before we do consolidation, we have to understand the financial relationship. In addition to the buying, purchase, what else? The financial relationship. So control the invested and being invested and the investing relationships between two companies. Then we can start understanding subsidiaries, parent companies, and subsidiaries. So we all know stock markets. That's a very simple term. You know, we know stock can be circulated, shares can be circulated or not. But we all know company can be just bought in shares, right? So recently, I guess everybody knows there's a lot of buzz about a Tesla. So let me ask you a simple question, right? If you go out there, assuming you have enough money to buy 100 shares of Tesla, which is a lot of money already, but compared to Tesla, total shares available is nothing, right? So what I'm asking is, if you go out there, buy 100 shares of stock of Tesla, what might your intention be with those stock? I guess it's quite easy, right? Buy low. I hope I'm buying low, and I hope the price will go up so I can sell high, make money. So let me ask another question. How long are you planning to hold it? Are you going to hold it forever? What you holding it ever to, right? What you holding it forever for? I don't understand, right? You are holding it until you see the price is high enough, right? So let's say you bought a Tesla at 1,500 per share, right? Now let's say the price is 2,000. The only reason stop you from selling is that you didn't think you make enough money. So you could have 500 in your pocket already, but you chose not to. You're waiting for other. You are gambling, right? So if you're gambling, that means you are giving up, or not giving up, that you think you have the 500 in your pocket already. You try to make more. Do we see that? We'll talk about what those means. On the other hand, there are other purposes of buying shares for, right? Give one case, for example. Let's say today, Walmart announces they're going to buy a lot of shares, maybe 15%, or maybe 20%, or maybe 25%, maybe 30%. Anyway, we all know that Walmart wants to buy a lot of shares of HEB. So let me ask you, why Walmart want to do this? Do they want to buy low and sell high? It's unlikely because two reasons, right? We know that the rule of thumb of investments, you have to diversify the risk. And when you diversify, of course, it's not a smart decision. You don't have to, if you just want to profit from it, right, by buying low and selling high, probably you don't have to buy so much of HEB, right? So there are other reasons. And also, HEB and Walmart, they're both in grocery business. So what could potentially happen is, if the grocery business is good, everybody happens to need more, buy more, that means both will probably do well. So for Walmart to buy HEB stock, it doesn't seem to have too much sense for the reason just of buying low and sell high. So what could the reason be? Right? We know in all the neighborhoods, we see Walmart and HEB, at least in the Texas place, right, appear in similar regions covering different areas, right? And of course, we know HEB is very popular in Texas, but global-wise, national-wise, Walmart is much, much, much of a bigger player. So the only reason I would think is when Walmart wants to buy HEB stock, they want to buy a lot, the only reason would be strategical purpose, right? For whatever reason here, right? It might be market share. Right? Walmart is already covering some neighborhoods, and HEB are covering some other neighborhoods. Walmart don't want too much competition, so by buying HEB, buy a lot of HEB stock, Walmart hopes to either control it if Walmart has enough stock or gain enough power, or have significant influence over HEB, which means influencing HEB's decisions, right? When Walmart has a lot of, not controlling, but a lot of stock of HEB, that can happen as well. So it is strategical purpose, right? And in this case, do you think Walmart's intention of buying HEB stock is just to buy low and sell high? Probably not, because for a company to buy a lot of shares of another company, they have to go through really a lot. What problem do we have to go through? Right? When companies, SEC, we all know SEC, right? Security Exchange Commission. Right? The SEC tells companies, if you want to buy a lot, if you want to buy another company's stock for strategic reasons, you have to start. You have to announce your purpose when you have the first 5% of the target company stock. Why? To encourage a fair market transaction. You have to let everybody know. So give the companies, give the other investors enough time to have proper reaction. Right? So if you think about it, if you really want to buy 20%, if Warburg wants to buy 20% of HEB, and if they started announcing it from when they had the first 5%, right? What could happen? HEB, those big shareholders could react by not selling, or they could be asking for more money, right? So it's really taking a lot of effort for a company to own, to buy a lot of the other company's shares just to value and sell high, right? What do they want with that? We talked about that in this case, market share, right? Sometimes people do this purchase to buy for the future, and sometimes people companies do this for some enhanced supply chain, sales channel, right? Or entering different area. Right? Remember, Google many years ago, Google purchased YouTube, right? Which was a smart decision. By purchasing YouTube, controlling YouTube, Google entering this online video business, although they are losing maybe to TikTok from the short video perspective, but still, I think YouTube is one of the biggest players, right? The sharks, whales, or what we call. Right? So do we see that? And if we really recall what we learned probably in intermediate 3, we have similar concepts, right? When we talk about company stock investments, stocks, remember, we have 3 types. One is called a trading stock. What is trading stock? When companies buy stock from stock market, their purpose is to buy and sell high, meaning that they have no intention of keeping it just for the sake of keeping it, right? They call it trading stock. Trading stock has to be measured, be accounted using fair value, market value, as some people call it. And we also have held to maturity stock. What is held to maturity stock? Held to maturity stock is those stock when companies buy, they don't want to sell. They want to hold it as long as possible. Right? So it maps into our strategic purpose, right? Why do you want to hold some stock as long as possible? Because you have reasons other than buy low and sell high. And in a rational business world, what's the reason you don't want to buy low and sell high? Because you got other things to gain, and those are strategic, right? You have to have a lot to have influence. You have to have a lot to have control over the company. You want to control, you want to have influence about. So held to maturity maps the strategical purpose of stock, strategical stock purchase we just mentioned. And between those, we have available for sale. That's another animal. We won't talk about it today. But recall that we said when a company big buys company small shares, when they just want to buy low and sell high with no intention to control, and we use fair value. Why use fair value? Because they just want to buy low and sell high, right? They want to trade. It's for trading only, trading stock. And when company big buy company small stock, and if they want to buy more, either to the extent they have significant control, they have significant influence over company small, or to buy even more so they can have control over company small. This is for strategical purpose, right? And it's not buy low and sell high. They don't want to profit from just the selling. So from this perspective, we cannot use fair market method, because fair value method, because fair value refers to market value, which assumes the stock being purchased will be sold when the price is high enough, and it will be available for sale anytime when the holder wants. But when we talk about this kind of investments, of course, they don't fit. It's held to maturity. We have to use historical cost method, right? So as long as we set this clear, we read this, let's do some journal entries to see how we capture this, all right? So remember, now we are working on the fundamental knowledges of consolidation. Okay, we are not touching consolidation, the core of consolidation yet, just the beginning of consolidation. So again, remember what you said. I want you guys to read the transactions, right? Then we try to describe it. Then we can write down journal entries, right? So here are two things. I'm going to film in two scenarios. One is the company just to company big, just to want to buy low and sell high. Okay, here we are making journal entries from the perspective of company big. All right. So we have, let me give it some colors so nobody will make mistakes. Yep. What is bad? Good. Doesn't matter. All right. So here we have several events, and we're gonna first talk about when what happened. What's the journal entry when company big wants to buy low and sell high? I'm not sure what I'm typing here. And then we're gonna talk about for strategical purposes. All right. So again, if company big buys stock of small, intending to just buy low and sell high, which we are saying they just want to make money, we said we call it fair value method. Why we call it fair value method? Why we call it fair value method, or why we use fair value method? Because in this case, the company can buy and can sell anytime they want, right? Company big has no intention to hold company small stock, right? The only thing would stop company big from selling company small stock is either they think they will lose less money or they will make more money in the future, right? So by the end of the year or by the period end, no matter it's a loss or gain from stock, company, the only thing stops company B from selling, from really cashing those profits or losing lot, eating the losses, is that if they think they will lose less in the future or they will gain even more money. So company B, company big had the option, right, to turn profit or report losses, but they chose not to, right? They could, they chose not to because they want to make more. So this is the difference, right? So from this perspective, if company B could, but they didn't do it, we use fair value method. Because everything has to be fair value. Because fair value is the reason company to be big decided whether they should buy, they should sell or not sell, right? Because they want to make more money. Can you see that? They compare the fair value at that point of time to the value in their minds. Okay. They don't hold it forever. They have no special attachments. They have no special needs for it. So on January 2018, company big bought 10,000 shares of small for $10 each. So before we write on journal entries, right, I want us to start like this, practicing like this, all right? So what happened here, right? What happened here? We know that a company big bought shares, 100,000, 10,000, right? And it's so company big gained shares of small 10,000. Okay, that's what the company gained, right? That's what a company big gained, and they gain shares of company small, of course, to hopefully to make more money. And this is assets definition we talked about. So the 10,000 shares are assets. 10,000 shares of small are assets of company big, right? So next question is, how much are these? And we know that a company big paid $10 for each share, so it's 100,000 shares. So the value of stock is 100,000 shares. And the third question, final question is, what did the company big do to get the 10,000 shares worth of $100,000, right? I mean, for us to get something, we can either work hard to earn it, or we can swap with somebody else, right? I mean, you rob, you still worked hard, I guess, from some perspective. So normally for a company, it's the same, right? They either give something up in exchange or they earn it. In this case, they give up cash, right? So cash is an asset, it's going down. So credit cash, that's what they give up, right? And a debit what? Debit, I would say stock. stock of small. I'm going to talk about that later, but let's assume it's stock of small, okay? So how much are they? 100,000 because it's 10 bucks, 10,000. 10 bucks, 10,000, right? Easy peasy. Right? Some of you might still be a little bit confused after, I mean, this, a long time, but I think this interpretation is pretty clear, all right? So we know that, right? What we know is they give up cash for stock of small. So on March 1st, 2018, Small announced and gave out cash dividend in the amount of $1 per share. What does this mean? Okay, so again, let's ask this. What is cash dividend? Basically, everybody who holds a share gets $1 of cash, right? And in this case, let's ask, what did the company big get from this transaction? It's quite clear. They had 10,000 shares and they got 10,000 bucks, right? So debit, cash, so the next question is going to be a little bit tricky. How did they get it? Did they give up anything? Probably not, right? They didn't give up anything. They didn't swap for the cash. They didn't swap anything for the cash. Did they earn it? I mean, if they didn't give up anything, probably they might be borrowing it, right? But if they didn't borrow it either, so they must have earned it. And how did they earn it? They earn it by receiving the cash dividend because they picked it well and the stock generates returns for them, for company big, right? So it's dividends income. They earned it. Okay, are we good? By the end of 2018, Small earned a net profit of $3 per share. I mean, when a company makes money, net profit, they divide the net profit over total shares available, calculate, hey, for every share, how much did we make? But in this case, right, Small announced their share, their profit is about $3 per share. So a lot of profit, let's assume, right? But in this case, did Big get anything? No, Big didn't get anything. Can you see that? Because we said the only thing affects is fair value, right? If Small earned a lot, did really well, they should the stock price should capture it. The stock price should go up because Big don't have any intention to profit from hold it forever. So really, technically speaking, earnings doesn't matter, but the stock price matters. Stock price would go up if earnings is really great. Right? I know it's a little bit tricky for some people to understand, but let's say if a company does well, right? If a company does well, earns really a lot, stock price would have captured too, right? If you buy some company's stock, it really doesn't matter how much the earning is, as long as the price increases. If you buy stock of Tesla, all you care about, you don't even look at financial statement, most people, right? All they look at is they look at the price. Earnings high, earnings low, it matters. It doesn't, but what it really matters at the end of the day is price changed a lot. If you bought it 10 bucks per share, and what you care about, whether the time you want to sell, it is 15 bucks per share. Do we see that? So by the end of 2018, Small earned a net profit of $3 per share. But if you really think about what this news means to Big, it's really not a lot because they are not really gaining anything. Can we see that? Because we are using fair value method, and we didn't talk about a fair value of this, right? However, next piece of information, we have fair value. By the end of 2018, Small stock price increased to 15 bucks per share, which is 5 bucks per share, right? So what happened to Big, right? Their investment of stock in Small, the value gets higher. By how much? 5 bucks per share, 10,000 shares, so 50,000, right? We good? All right. So I want us to think about why we don't have any journal entries here. All right. Think about it. It's not that earnings, net profit don't matter, but when we use fair value, we think about the market price of stock, and the market price captures this profit already. Okay. Because when you sell, all you get is that $5 per share price increase. Profit or whatever don't really matter, or doesn't matter directly at least, right? Now let's see what happens when it comes to strategic purposes, right? When you when you hold a company stock forever, what is strategic purpose, right? Hey, this company is a pie. I want to profit from this pie, right? I want to profit. So I don't care about the market price. So market price don't matter to me anymore. And then we use historical cost, right? What is historical cost again? Historical cost is like, okay, how much I paid for it. And then that's my measure of companies, of my investments. And when companies stock price change, I don't really care about it because I want to sell it. What it really matters to me, how I know my investments is getting better or getting worse or getting bigger or getting smaller. When a company does better, operates well, because now this time when we do it for strategic purposes, we call it equity method. It's really a historical cost method. When company stock price don't matter anymore, right? All I care about is when I know the company I hold a lot of stock for, they make money, have profit. I know the company gets bigger, right? Because they have net profit. And then when they have losses, I know my company gets smaller and my share gets smaller, right? And then when they give dividends, we're going to talk about that, right? So here for this, there's no difference, right? Again, I said, no matter if we think about it, right? If we think about it, company big got shares of small. How much did they pay for it? How much did they pay for it? They paid 100,000. So they got a stock of 100,000 of small, and they paid cash. Their cash is reduced by 100,000. Right? It's crystal clear. On March 1st, 2018, Small announced and gave cash dividends, $1 per share. So in this case, we do journal entries from Big's perspective. So let's ask ourselves, what did Big get from this event, right? Obviously, Big received the cash. So still, we debit cash. However, in this case, we have to ask ourselves, how did Big get it? I know when we use fair value method, we mentioned that it's kind of the dividend income Small earned it because Small didn't lose anything, because everything Small measures investment as a market value. As long as the market price didn't change, they didn't lose anything. However, when we use equity method, remember historical cost is kind of different now, right? So if we visualize it, who gave out cash dividends? Small gave out cash dividend, right? So Small give cash to other folks. What happened to Small? Small will be bigger or smaller? Small will be smaller by the cash dividend they give out, right? Just assuming you have a bank account, okay? You have a bank account, right? You withdraw from the bank account $10,000. Your bank account will get thinner, right? And your cash, you will have, did I say 1,000? Your cash will be more by 1,000. So if you withdraw 1,000 from your bank account, you would have hypothetically say that, okay, debit cash in hand, 1,000, credit bank cash, 1,000, right? Can you see that? So when we use equity method, when we measure anything by historical cost, exactly to follow what is accounting value has been earned and distributed to the shares Big owns, right? We are really talking about what is from small own perspective, what has they earned, what has they lose at each point of time. So in this case, small, right? For big, small is like a pie of a pie, right? And big owns a percentage of it. When big claim cash from small, the pie is getting thinner because they give up cash, right? So in this case, nothing gains. Big just cashed out 10,000. They cash out, their investment gets smaller, right? So let's call it investment in small. Okay. So basically, we put those two transactions together, we can see that, all right, so on the first day of 2018, Big used the 100,000 bucks to get small stock, the investment in small worth 100,000 bucks. And then on March 1st, 2018, Big cashed out by 10,000 bucks. So the investment, because it's cashing out, investment is smaller, lower by 10,000 bucks as well. Then we look at the next. By the end of 2018, small earned a net profit of $3 per share, right? So let me ask you this, all right? What if big, so small earned net profit of $3 per share, right? It means small is getting better or worse? Better. Better in what sense? Getting bigger, right? Net value was getting bigger. Bigger by how much? $3 per share. So big owns a portion of small. What happens to big's investment when small gets bigger, when the investee company gets bigger? So proportionally, it gets bigger too. $3 per share, right? So in this case, Big didn't receive any cash for sure, but because we use historical cost equity method, so the investment's getting bigger. Bigger by how much? We know that a Big has 10,000 shares. Each share is more by $3, right? So, and now how did Big get it? Did they lose anything? Did they borrow anything? No, they didn't. They earned it, right? So invest. And then if we move on to this event, let me tell you, we probably won't do anything this time because by the end of 2018, small stock price increased to 15 bucks per share. But we know that Big buys small share for strategic purpose. They will not buy it on the sell high, so stock price doesn't matter to Big, right? So this piece of information is irrelevant, all right? So this is our first class, and we talk about how to account for it. In the next class, we're gonna move on to consolidation, the fundamentals of the consolidation, and we're gonna talk about how this starts to as a foundation of us to do consolidation. All right. Pay attention to our Blackboard. I will put homework there. Thank you very much.